Now we can move on to the next rule of the strategy. Let's consider the money management rules. Two different methods of money management can be applied to double barrel gun trading strategy: conservative and aggressive. However, before describing these two methods, I would like to remind you the differences between long-term and short-term trading. What are the key differences between these two types of trading? Please take a look at the diagram on the slide. The long-term trader can maintain his position for the period of several days, weeks or months. The goal of the long-term trader in each separate transaction is to make profit from the large market movements. In the case of the favorable outcome, the price movement could reach 200 to 300% of ADV or even more. The long-term trader will get a relatively small number of trades and fairly good result in point terms, provided that he complies with a favorable profit-loss ratio. In order to do this, the trader should be engaged in only those transactions where the potential profits are 2 to 3 times higher than the potential risk. The favorable profit-loss ratio and the opportunity to earn hundreds and even thousands of points per trade determine the success of this approach. As for the short-term trader, his entire trading activity is concentrated within a limited price range, the size of which is determined by the average daily volatility of the instrument. For instance, on the Forex market, the average daily price fluctuations do not exceed 100 to 150 points per day for the major currency pairs and cross rates. For the intraday trader, the ultimate goal is not about trying every time sell the highest high or buy the lowest low of the day. Only few can succeed in doing this. The goal of the short-term trader is to consistently and constantly profit from the small intraday market movements, less than 1/2 or 1/3 of the value of average daily trading range. In each winning transaction, trader will get quite modest results and points, but the cumulative profit can be quite impressive. The opportunities for short-term transactions will appear almost every day, or even several times a day. This is precisely what determines the success of this approach. Which of the two types of trading is more appropriate for you? There is no definite answer to this question. In my opinion, only practice will help you to understand yourself. Only in real trading, you will be able to test your tolerance for risk, to which you will be exposed by your trading strategy in each transaction. Only real trading will test your ability to resist the temptation to violate your own trading plan when your paper profit is growing. Now we can move on to the question of the effectiveness of the double-barrel gun trading strategy. Traders have developed different statistical methods for impartial evaluation of the performance of trading strategies. Here, it is worth mentioning an interesting research conducted by the authors of a remarkable book about development in testing the trading strategies. By the way, the book that I am talking about is in front of you on the slide. Its full name is Technical Trader's Guide to Computer Analysis of the Futures Market. The authors of the book, Charles Lebeau and David W. Lucas, offer an interesting approach which allows you to get some idea of the reliability of any trading strategy. They use several different performance criteria to determine the probability of the strategy failure. Here, I mean the probability of ruin, or POR for short. The POR allows a trader to estimate the likelihood of a scenario when the balance of his trading account will sink to a certain point before it will rise to a certain higher point. The calculation includes 6 variables: the percentage of wins, the average gain and the average loss in dollar terms, the initial account balance, the level at which one can say that the strategy has failed, and the level at which one can say that the strategy has been successful. The following table shows a representative set of values, such as the percentage of winning trades and the average win to average loss ratio. To simplify the calculations, the initial balance of the account was set at $25,000, the target level was set to $50,000, and the failure level was set to $12,000. As you can see from the table, the POR sharply changes, along with the changes in the percentage of winning trades and the profit-loss ratio. A small correction in the rules of the strategy that results in a positive change of any variables can make a huge contribution to the future possibilities of the strategy. So, the main factors that determine the degree of effectiveness of any trading strategy include the following. 1. Profit-loss ratio. This parameter may be in the range from 2 to 1 to 4 to 1 or even higher in the case of long-term or medium-term trading strategy, and in the range of 2/3 to 1 to 3/4 to 1 and higher in the case of short-term trading strategy. 2. The percentage of winning trades. This parameter may be in the range from 30 to 50% or less in the case of long-term or medium-term trading strategy, and in the range from 60 to 70% and higher in the case of short-term trading strategy. 3. Sufficiency of trading capital. I think that no one will doubt the need to have some kind of safety cushion in the form of spare trading capital in the event of a series of losing trades longer than during backtesting, and consequently, more profound account drawdown. Based on the above, it is pretty obvious that a short-term trader will earn his money on the market only if the size of the potential profits will be comparable to the size of the potential risk. But the number of winning trades in the series of trades will be at least 2 times higher than the number of losing trades. I try to stick to this rule while developing my own trading strategy. Now we can move on directly to the money management techniques that can be applied to the double barrel gun trading strategy and choose the one that suits you best. The first method of money management is conservative. In accordance with the rules of this method, the trader risks only a small portion of his initial capital in each transaction, ranging from 2 to 4%. The maximum number of opened positions in the portfolio of the trader should not be more than 3. Suppose a trader opens a real trading account and made a deposit of $3,000. Thus, according to the rules of the conservative approach of money management, the financial risk of the trader in one single transaction would be limited by $60. Depending on the market situation, the value of the stop-loss order set by the trader to limit his losses will vary from 1/4 to 1/2 of ADV. Thus, knowing the value of stop-loss in points and the limit of financial risk in dollars, trader will be able to determine the size of transaction in lots or units. Operating by the rules of conservative money management method, the leverage used by the trader will not exceed 12 to 1. The second method of money management is aggressive. In essence, this method is a variation of the Martingale betting system. As you may know, in its purest version, Martingale is a method of controlling the size of bet used in the casino game of roulette. In accordance with the Martingale betting system, player doubles his bet after a loss and returns to the initial bet after a win. Of course, I do not recommend using Martingale method in its pure form for trading by the rules of double barrel gun strategy. However, you can use a modified Martingale in order to increase the productivity of the strategy. Here's how it looks in trading. Let me remind you that in the double barrel gun trading strategy the average profit-loss ratio is close to 33 to 45, and the average percentage of winning trades is close to 60 to 65%. In accordance with the aggressive money management method, the first transaction has to be made by the single lot, the size of which depends on the limit of allowable risk. If the first trade is profitable, then the next one, just like the first one, should be made by single lot. On the other hand, if the first trade is unprofitable, then the second trade should be made by double lot. If the second trade is profitable, then trader makes up for losses incurred in the first trade and earns a small profit. After that, trader returns to the minimum lot in the third trade. However, if after increasing the lot size in the second transaction, trader receives second loss in a row, then, in the third transaction, he still should return to the single lot. Why the trader should not increase the size of the trading lot in the third transaction for the second time? The first reason why this should not be done is that even after increasing the size of the lot, trader will not be able to cover the total loss occurred after 2 consecutive losing trades. The second reason why this should not be done is that by doing so, trader would expose his trading capital to much bigger risk. I often apply this method of money management to my basic roulette strategy in online casino. So, in the case of the aggressive money management, the trader risks only a small part of his initial capital in each individual transaction as well. But he can vary the size of the trading lot, depending on the outcome of the previous transaction. Suppose a trader opens a real trading account and made a deposit of $3,000. Thus, according to the rules of the aggressive approach of money management, the maximum number of opened positions in the portfolio of the trader should not be more than 3. The financial risk of the trader in one single transaction would be limited by $60 or $120. Depending on the market situation, the value of the stop-loss order set by the trader to limit his losses will vary from 1/4 to 1/2 of ADV. Thus, knowing the value of the stop-loss in points and the limit of the financial risk in dollars, the trader will be able to determine the size of the transaction in lots or units. Operating by the rules of the aggressive money management method, the leverage used by the trader will not exceed 20 to 1.